Good morning, everyone. Thank you for being here early. My name is Barry Thomas. I'm not Ryan Ebner. Unfortunately, my colleague Ryan has just been taken sick. So someone very wise once told me, get your excuses in early. So I've had about 3 minutes notice for this panel. Fortunately, I have Ryan's notes. But anyway, appreciate the guys joining us this morning and you being here early as well. Do we want to do intros before we kick off? Listen, maybe I'll tee up with a question, and each of you can maybe introduce yourselves, and then go into the content. The panel is myself moving towards a 5% benchmark. I think maybe an interesting question just to kick off is, given what's happened in the markets in the last couple of days, your observations on that, and perhaps whether or not these kind of volatile events impact or affect the ability of investors to reach that kind of benchmark over the coming years. And I'll let whoever wants to jump in first.
Hi, I'm Rob Rozario from Alphaparty Capital. I'm the CEO and founder of that company. We're a hedge fund, systematic hedge fund based in Cayman. Look, just taking to your point about what's happening in the markets in the last couple of days. I mean, I think a lot of what we've seen has been driven by negative sentiment. I mean, there's been a perfect storm of geopolitical problems, especially talking about Iran. Trump has been talking about Greenland. And all of these has been caused a lot of instability and uncertainty about what's going on. So I think that's one thing. The other thing is really a lot of technical factors. I mean, once you hit about 75, I mean, that's a key support level. Once you go through that, then you get a lot of liquidation. So I think once we passed through 75, it was eventual that we were going to go into the 60s, right? I think everyone kind of saw that happening. I mean, that's a key support level. We bounced off 60. I mean, if you asked me a couple of months ago where I saw the low was, I mean, I would say 75. I mean, that was my answer to anybody that asked me. But look, now that we've actually gone through it, I think it's interesting to see where we're going to go from here. I think the sentiment will improve eventually, but ultimately it's driven by all these other factors and fear in the market. So, you can see gold's rebounded. I mean, tech stocks are down. So it's a volatile market at the moment. But, volatility is no stranger to BTC. We've seen that for a long time. I don't think it's a bad thing at all that, we're going to where we are at the moment. And ultimately, that's my opinion on what I see in the market at the moment.
Hello. I'm Arunkumar Krishnakumar. I look after institutional partnerships and allocators for R3. R3, we are, it's a firm that's been around for 10 years now, but we now kind of pivoted from private blockchain into public blockchain. We are building the RWA marketplace on Solana. And my role is to really drive the right assets and TVL onto the protocol. Going back to the question, yeah, it's actually funny. Sometimes we talk about volatility of this asset class when we have silver wiping out $4 trillion in a session, right? And if silver and gold can do that, I'm not sure if we should be talking about how good an asset Bitcoin is, or we should be judging the asset class and asset on volatility. I think the fundamentals are still sound, I believe. And particularly with dollar being devalued at an alarming pace, I think this just beefs up the case for Bitcoin in the medium and long term.
That case being what, do you think, like as a store of value, as a digital gold?
Yeah, of course. For Bitcoin, for me, in my view, the narrative has always been store of value. I don't know if I would like to call it a digital gold. It's going to take some time for us to get the asset to that point, but I still believe it is considered to be the store of value, at least on the digital asset side. In terms of where the market is today, I think your guess is as good as mine. I was hoping for around 70K bottom, or I'm not a technical analyst, but I wasn't expecting this kind of and not definitely not at this kind of rage. But we are at that point in time in the cycle. So with crypto, you get to, both, when it runs up, it runs higher than you would expect, and when it goes down, it goes more aggressively and falls flat. So that's what you come to expect. You've been in this space for some time.
Yeah, thanks. Andrew?
Hi, thank you. My name is Andrew Forson. I'm the president of DeFi Technologies and chief growth officer of one of our subsidiary companies, Valour. And Valour has the distinction of having 102 digital asset underlying ETPs. I think at the moment that's probably one of the companies that has most digital asset underlying ETPs. Look, I've been in the game a while. Markets go up and down. That is one of the key features of markets. And I guess I come at this from a slightly different perspective in that oftentimes you have certain commodities and assets that actually don't have a use technologically or otherwise. But in this case, the digital asset space, and specifically blockchain, it actually serves a use. It serves a purpose, and there will always be a price associated with it. Now, the purpose that it serves is the whole idea of a decentralized ledger. It's a very real thing. Programmers use it for a very specific reason, and there are fees associated with it because that's how you validate the transactions on chain. In the case of Bitcoin, it is true that some in the media, when the price goes down, they say it's not worth anything. When the price goes up, it's the greatest thing. But the reality is we don't have many deflationary or non-inflationary assets today. If you look at this beautiful country, the country of my birth, Canada, actually of 195 countries, 190 of them are issuing debt that they cannot repay. They don't know how they're going to repay it. So at some point, we need to have something that is a non-inflationary tracker because we don't have a gold standard anymore, and we tend to need things to be able to anchor actual value. And so there will be volatility in the markets. As my colleague Arun had mentioned, it is never good when the superpower of the world is at once threatening friendly countries like Denmark and Greenland. And as a Canadian, I can say, you know, our national word is sorry, so we don't know what's going on at all. Like, Canadians don't piss off anybody, but somehow we've managed to tick off the US. So yeah, that's going to create a degree of uncertainty and volatility where people don't know whether money should be going into gold or out of gold, where a government selects a Fed chair that is at once hawkish on interest rates when they know that the president has basically demanded low rates. So I think we just need to be patient. I think we need to be patient. And we need to understand that a lot of this technology has an underlying use, explosive use cases like stable coins, and there is a dynamic shift. But I don't think anyone in their right mind would say that DLT, blockchain, or AI is going to disappear, right? So I think there's a bit of irrational unexuberance, if that's a term.
And what's up, everyone? My name is Alessandro. It's a pleasure to be here with all the panelists. So I represent a company called Crypto Finance. We're a regulated broker and custodian in Switzerland and in Europe. We're fully owned by Deutsche Börse. And unlike some of my peers, what we have historically done at a group level and also in the crypto space has been providing neutral market infrastructure on the trading side again, on the custody side too. So I think today's topic is going to be an interesting one because we're obviously not in a position to shove crypto down anyone's throats to get that allocation up. But at the same time, we're hoping for everyone to shove crypto down people's throats to get that allocation up. That said, to comment and add to what my peers mentioned, I think it is true that the volatility is either increasing or decreasing the flows into the crypto space. And I'm talking about crypto, but of course we could talk about all sorts of other assets that are based on the blockchain. What is, though, regardless of the volatility, I think undeniable, is that the reach of blockchain-based products is increasing in one way, shape, or form. And I'll give a very specific example. If I look at our core clientele, which are banks, generally speaking, a drop in price, even if it's in the mid double digits, will generally not slow down their intentions to increase the service offering to their end customers. AKA, if they get a project approved and budget to do crypto trading, whether it's Bitcoin and Ethereum, they're still going to do it. Why? On one hand, because it takes them a while. It's not a couple weeks worth of work. So if the price drops, they will still go ahead, make it happen, and the final product, even though there might be, well, arguably if the price goes down, their retail customers are going to buy at a lower price, which hopefully is going to be better for them in the long term. But they're still going to make it happen, and I think that's something that's important. Now, that's important for spot. I think we're going to talk about a bit spot versus products later on. But this is also important for products themselves. If you think about ETPs, I think in the UK, up until maybe a year ago, they couldn't even be bought by retail investors, right? So there were restrictions to accredited investors and the likes. So the market is structurally changing, and I think it is creating a platform for the allocation to be going up. Now, today, I think we're more in an execution-only type of world, especially on the banking side. Maybe 1% to 3% is a number that resonates more with people, but potentially 5% is going to be the next step in that ladder.
Okay, got it. Thank you, guys. Thanks for those introductory comments. So coming back to the topic on moving past the 5% benchmark, I mean, I think the idea here was to talk a little bit about some of the milestones that needed to be reached in order for allocations to get up to that level over the coming years. And I think one of those is talking about developments in infrastructure, developments in wrapper structures. Obviously, there's been a lot of development, very positive development in recent years in terms of solutions around custody, off-exchange settlement, key management. Would welcome any views on whether or not how far we are along in the progress there in terms of the industry, whether that piece is kind of solved already, or whether there's more a development that needs to happen.
Look, I might make a few comments around that. I mean, there's a lot to unpack there. I mean, I think for an institutional investor, when we're talking about institutional investors in general, I mean, that's a large group of a very large term, right? So, I mean, some of these topics like off-exchange settlement wouldn't even make sense to a lot of these guys, right? I mean, self-custody of assets is something they're not familiar with. How do they do that? So there's an education gap over there as well, and there's gaps on the infrastructure side as well. I mean, I think if you're looking towards being a proper institutional investor, you need to really understand how you're going to be custodying your assets, right? I mean, it's a new idea of you self-custodying assets, or you have to work with someone who's qualified. I think something that's going to come up in the future is going to be that institutional investors are going to demand that custodians are regulated, right? I think that's going to be a big thing moving forward, which we're not seeing yet from the family space, but I think moving into institutions, they're going to demand that. So there's a lot of things in there. I mean, infrastructure, custody, how do you account for these assets as well? I mean, one thing we sort of talked about in terms of volatility of BTC, I mean, depending on how you account for your portfolio, I mean, you mark to marketing on a daily basis, or is it going to a long-term book? I mean, how you account for that is also important. So, I mean, there are many, many things to sort of unpack over there. But just on the infrastructure custody side, I mean, there's a lot to understand. And I think the first thing is the educational gap that needs to be bridged, right? So people really understand what they're doing. Before you make an investment, you need to understand what you're actually going to be doing. You need to explain to your stakeholders and shareholders, how that's going to play out. So I think we're still at that point at the moment.
If I may add, I think for me, even though there still are some areas for improvement on the structural side, on the custody side, et cetera, I think it's more of a cultural battle still. Specifically, in the early days, in 2017, when a lot of the institutional providers, for example, started on the tech side, be that custodially or non-custodially, the track records were obviously short, the balance sheets were limited. So all of a sudden, a lot of the participants that wanted to provide access to the asset class were almost forced into the self-custody area. Now, self-custody is not something that is very common in traditional finance, but you'd rather insource the tech risk than have counterparty risk to someone who was born yesterday. Fast forward now, 2026, European, so MiCA has the regulation in place. Switzerland has been regulated for as long as I can remember. The Clarity Act is around the corner, hopefully in the United States. There's a lot of fantastic regulated setups out of Latin America as well. So there's plenty of custodians that can give that peace of mind and not force the distribution channel to take on the responsibility of managing the assets, and rather just focus on, hey, this is the type of allocation that I want to have because this is the type of upside that I can get. Now, on the other side, crypto as an asset class is still very small. Okay, I'll make a example that touches Deutsche Börse specifically. The CSD in the group, Clearstream, has 20 trillions in securities in custody, okay? So a private entity has 5 times amount in custody than the whole asset class that we're all here discussing, right? So it becomes difficult culturally to transition, for example, from a pure execution-only approach to let's put this in advisory mandates and discretionary mandates, because the risk return is still something that is not on everyone's table just yet. And I think that is what is slowly starting to change. In Switzerland, I think there's now 2 banks that are including crypto as part of their mandates. Most of the ecosystem is very much on an execution-only basis. Let's create the pipes. The reputational risk, consequently, is very limited. It's not zero, but it's very limited. And I think that's where the next step of adoption is really going to come in.
Just have a few points to make on institutional custody. So when I first started on my first project on Solana, it was a staking project. And if we wanted large institutional clients to stake with us, we've had to have integrations with custody providers such as crypto finance, Coinbase, Anchorage. So it was a minimal requirement. They were not going to kind of do the self-custody and link directly to our dApp to stake. A couple of years later, when I was on the lending protocol, it was slightly better because these custodians had figured out their DeFi strategy. It was much easier. But now the bar has been raised massively because the world is starting to move towards RWAs. The world is starting to move towards tokenized TradFi assets. And the most recent conversation I had with a couple of issuers is, hey, we are happy to work with you at R3 to take our products and distribute it via your RWA marketplace, which is a DeFi app. But do you have integrations with traditional custodians, which is not the Coinbases of the world, not the Anchorages of the world, but JP Morgan, BNYM, and Citi? So the bar and the line between TradFi and DeFi is starting to blur out, and I think that's kind of where the world is going.
Again, I like following Arun because I completely agree with him. I'll come to this from a different angle altogether. So we're a publicly listed company, DeFi Technologies on the NASDAQ. So that means, as president, I get the distinction of getting to speak with shareholders, buy-side analysts, sell-side analysts often. Most of the time, it's fun. This week, it's not so fun. I'll let you surmise why. But one of the interesting things about this, and they all know that our core business is we issue structured products, and we list these structured products on traditional stock exchanges so people can gain exposure to digital assets through their broker-dealer. The thing is, a lot of these high-powered analysts, portfolio managers, if you mention to them custody, staking, yield, their eyes glaze over. If you mention to them any digital asset other than Bitcoin and Ethereum, they're like, yeah, okay, yeah. And then in a private conversation or WhatsApp, they'll ask you, what does Solana do anyway? So I think one of the key hurdles to moving past the 5% benchmark or even getting to the benchmark is just ease. Now, this technology started with a bunch of sort of nerdy people coding stuff in basements, but the problem is it's actually hard to do blockchain stuff. I think anybody who's dealing in custody understands how difficult it is. Then you add regulatory stuff, it becomes more difficult. That needs to be overcome. That needs to be surmounted. The next thing that needs to be overcome is people need to understand where to get the signals so they understand what to invest in. If you want to do equity research on a company, you know where to go. You know how to interpret what the market is doing. We haven't seen anything that effective other than just showing AUM. So much so that we actually came up with our own index the Deft View Index, in order to be able to speak with equity analysts so they could see what is happening with long-tail altcoins, what is happening with the industry. They can understand what chains are being used for the great stable coins they're hearing about in the market. In that way, I would say the two key criteria in being able to enhance institutional adoption is going to be ease of implementation, of adoption of digital assets, and education in a way that speaks finance and doesn't speak Web3. Because speaking Web3 does not necessarily convert to good earnings per shares or discounted cash flow models, which is what the finance world likes.
No, I think the education point is extremely important. I mean, we speak with or try to speak with institutional investors continuously about the products we offer. And I think, the idea of getting towards 5%, perhaps this panel should be more about 1%, because the vast majority of real money investors, so endowments, foundations, pensions, are on zero right now. And I think the education, if you had pension fund trustees who were sitting in this panel now, they probably wouldn't understand the vast majority of what we're talking about here, just because they're not involved in the space and the terminology. So I think that education process is going to take a long, long time. And I think even getting to, I think 5% is probably somewhat far-fetched right now. If you look at crypto market cap as a percentage of global market cap of all assets, it's probably around 1%. So I think 1% would be a great target for the industry to reach. If we move on slightly, maybe as a natural progression to that, the next step is, Andrew, you mentioned ETPs, the delivery mechanism through which, or the wrappers through which products. Obviously, we have, our firm is a basically crypto hedge fund business, yours similar as well. We've seen a huge explosion in ETFs through the Bitcoin ETF, which has been the most successful mechanism. I think UCITS is an interesting, for European investors, is an interesting area to explore. Very difficult to put any kind of crypto into UCITS, but actually crypto-related equities now is a way through which you can deliver at least exposure to this space through more regulated products. I'd be interested to hear any observations you guys might have on how you think that evolves in terms of wrappers and structures.
Might just jump in. So yeah, definitely the format in which you invest is very important, right? So I was in Abu Dhabi Finance Week recently in December, and we went and heard from the Family Day with on every panel people were talking about digital assets. It was a hot topic over there. And what I can say is what came up a lot is what format do we invest in? How do we do that, right? If you're more familiar with equities, then ETF makes more sense, or those kind of listed products make a lot of sense. But fund format is, of course, almost number two, right? Taking actual direct underlying exposure to the asset itself is probably the least favorite for most people, right? So fund seems to be a very popular format, and that's certainly our format. I think having a fund is a very good way of getting in. The institutional investors and families are very comfortable with actually investing in funds. That's something that they do very often, so they're comfortable with that kind of idea, and making sure that there's a good regulatory framework around that supports it, makes sense.
I agree. I think though, and today I think there are different ways to get into the space according to the preferences, be that geographical, be that whether you are an investor that's more focused on, is it fiscally advantageous or not? Do I need to actually do something about the underlying or not? But I think something that is important, even though we started with spot and then all of a sudden we saw ETPs come into the space because that was the best regulated way of doing so. And there were a lot of single token trackers. Now those are becoming less popular and you're starting to see more complex setups. The question also is, what is more advantageous for example, the sell side? We have a lot of clients who have historically had on the shelf ETPs, ETFs. Now, in the early days, it was a lot of crypto native issuers. In Europe, there were quite a few. It pretty much probably started in Europe, then you started seeing others in Brazil. And of course, in 2024, once the BlackRock, I think it was Grayscale initially, but then the BlackRock ETF came in and all the other 10 or so came in, the whole industry changed, right? And all of a sudden, for an investor, you you had effectively lower issuer risk because you had a name that potentially was, you were more comfortable with, regardless of whether that's true or not. That said, the revenue potential for the distribution of selling an ETP or an ETF is generally significantly lower than also spot, right? And that is why we have some players that were massively successful. Biggest success in 2024 was, say, the BlackRock ETP or ETF. And all of a sudden, they want to try to capture against 150 basis points or 2% using spot, as opposed to selling a product that has a TER of 10 basis points with no distribution agreement, right? So I think that's also something to keep in mind, which potentially will lower the overall cost for the investor, pushing the investors farther away from spot and maybe closer to products. But that will also create some competitive dynamics with the distribution, which will instead want the investors to come through the more expensive products, which could also be a fund, of course.
Yeah. And any observations on how the industry might evolve in terms of active versus passive? Obviously, we've seen a lot of the growth in passive exposures right now. I guess many institutions, institutions where they have got exposure to this space have done so through IBIT or similar. So I think if I compare this to traditional finance, traditional asset management, there's a big move from active management to passive, and a lot of traditional active managers really struggling with that. I almost wonder whether or not you'll see the reverse in crypto. Crypto's actually started with passive because it's been the easiest way to get exposure. I'm interested to hear how you think about active management in the space.
Well, I think it's going to be, for institutions, it's going to be passive allocation to active managers. I mean, that's how I would see it. I mean, allocating to funds would make a lot of sense, right? People are actively looking at this, but they won't do it themselves. Internally, they're not going to be doing it. Their treasury won't be doing it. They won't be managing it themselves. They'll have to outsource that to somebody else. I think funds make a lot of sense for that, right? So,
go for it.
No.
All right. Okay. See, there's been quite a lot of trends these last 12 months or so that's been brewing in the space that's bringing in allocation from TradFi into DeFi. And some of them are pretty exciting. I'll just probably share that views. I don't know where this is going to end up, but it's starting to look more and more like TradFi. So for instance, vaults seem to be a new trend. In the last 6-7 months, that's they have picked up. So vaults are essentially, if you have a bunch of stable coins, like say $100,000 to deploy, if you're a bigger allocator, of course more, but let's say I've got $100,000 to deploy. I put my monies into vaults, and there's active management of that by who we call them curators, who are effectively on-chain portfolio managers. And they deploy the stable coins into that vault across multiple different lending markets like Morpho, Aave, Camino, and there they're able to generate yields and pass it on to the depositors into the vault. So that is one way of thinking about it.
Are these primarily catering to the kind of crypto native community right now, or can you see these solutions becoming more broadly available?
Absolutely. So I've been in conversations with, say, for instance, the top challenger banks in the UK, and they're all looking to integrate with vaults. How can I make a stablecoin holder, and in some sense they want to issue their own stablecoins in some of their cases, and have their stablecoin holders tap into these vault technologies. Now, the DeFi native version of these vaults effectively deploys stablecoins into lending markets, but now that space is evolving where you could actually tokenize TradFi assets like a private Hamilton Lane private credit fund or Invesco's BKLN. You could effectively tokenize those and package them into a portfolio of multiple different assets, which are effectively traditional portfolios, but now tokenized. Now, why do you need that? Why can't you just go and deploy your capital into a TradFi portfolio? The advantage of tokenizing it is now the vault itself is a token. You can use that as collateral on DeFi and borrow, which is typically not possible in TradFi. So when you have that level of capital efficiency, I think that makes it super exciting. Now, it's not done by any stretch of imagination. So much needs to be done in terms of capital infrastructure to get there. But these are the trends that's happening.
So one of the trends, I think that we could all borrow a lot from, Steve Jobs and Apple. He made things easy. And I reference that because I always look at adoption from the perspective of what I call the my mom test. So whenever I go home, my mom will say, Andrew, I'm really interested in investing in Bitcoins. Now, right when she says that, I know we have a problem, right? So immediately I start thinking, okay, well, I'll sit beside you, set up a Coinbase account or whatnot, and it doesn't work. And you realize, let's go the easy path, which normally ends up being a structured product that she can tell her broker to buy through a traditional account. The reason why I say that is I actually view the movement of this technology, it's just going to hybridize. When we talk about active versus passive, we just bought, as I was telling Alessandro, we just bought an algorithmic asset manager in Switzerland called, invested in, called Neuronomics. And to some extent, I don't know, are they passive or active? Because their strategies are being generated by AI systems, but the results are great. And whether they deploy these things in a tokenized instrument or we issue them onto an exchange, that line is being blurred because oftentimes you have the ability to do both. And if you are able to deploy a tokenized instrument to a tokenized environment, you gain access to a whole pool of capital that you otherwise wouldn't do. But from our perspective, if we can also wrap that into a broker-dealer instrument, my mom can buy it too.
Yeah, interesting.
I would also add that market dynamics, though, are making it harder or easier to be in one or the other. 2024, fantastic year for altcoins. In Switzerland, AMCs or common structure, super successful. There were small shops run by a couple people who were making plenty of money for themselves and for the investors. Now in 2025, many of them shut down because all they could promote was buy Bitcoin up until October. Then it changed. Then it's now difficult to promote at most, right? So I think active investment also requires an underlying market, which is exciting, which sees development that has substance as well. And so that's why I think a lot of the DeFi evolution, which piggybacks of the original 2021 entry of DeFi into everyone's dictionary, is finally starting to create some more excitement, because otherwise it's a pretty dry landscape if you look at just the base protocols developments across the world.
Yeah. So we have about 5 minutes left. Interesting maybe to hear a little bit about differences in geography in terms of adoption. I think we're quite broadly represented here. Aaron, Australian, Swiss, Canadian. Aaron, I'm not quite sure where you're from, but in terms of your home markets, any observations on the adoption of crypto and how institutions are thinking about this?
My home market, I mean, Australia doesn't have any regulation as such, really. I mean, they're talking to regulators. I mean, as far as my mother setting up a Coinbase account, I can't imagine that happen. I mean, look, the typical Australian would probably think that BTC has something to do with criminality. I don't really think we've got that much past that yet. And all of the jawboning from politicians and what I see in the media is pretty negative. So, look, I wouldn't really look to my home market. I really live in Amsterdam, so I could probably talk more about Europe. I think things are becoming more progressive in Europe, definitely. I mean, I think things are moving in the right direction. I mean, as far as most people are concerned, I mean, the direction from a regulatory perspective has been led by the US, as we would expect. And, Europe is coming along. I think things are looking up and up in Europe in terms of in mood. Yeah.
My home is India, but I've lived here for 21 years, so this is home away from home. Sure. And I don't have a crypto account with any exchanges in India, so it's all here. So this is technically home. But the market I'm super excited about, and which is clearly turning around the sentiment around the space, is the US market. Yep. And I think this was a panel I was sat on like 6-7 months ago, and someone asked, what's the one specific regulation that you're really keen on? And I said, it's not one single regulation. It's just the sentiment that I can go and talk to the SEC and get an exception. That opportunity is out there. I feel at ease talking to Senator Hegarty and asking him the question, how is this going to happen? What are the timelines? I couldn't do that 3 years ago. So that, to me, is a massive uplift to this industry. That's brought in a huge amount of legitimacy and credibility to this industry. I think that's the direction we need to go. It's going to take 10 years, 20 years. We're building a new age capital markets here. So it's going to take a long time. But I think the right infrastructure from a regulatory perspective is there, and that's what I'm excited about.
Yeah, for me, I actually think the markets that I'm most interested in are the 7 billion people outside of the developed countries that now can use technology to invest and keep their money in a store of fiat or capital that isn't rapidly eroded by inflation. I was speaking at the Canaccord Genuity conference at Canada House the other day, and I pointed out that in some countries they have 30% inflation per quarter. For somebody there, holding their money in a bank account in their local currency is just a non-starter. And for the first time in history, these people can hold their money in a stable coin, and soon they're going to be able to invest in RWA assets. I think when that happens, you're going to open the floodgates to hidden capital, to the unbanked, to be able to invest, and that's where you're going to see the digital asset space exhibit an explosive growth.
Yeah, very good point. Alessandro, we got 90 seconds left.
Final
word.
thoughts, yeah. So I've been privileged to be based out of Switzerland, where the first regulation realistically came into place with DLT of 2020, 2021 or so. MiCA is in great part out of the European Union, obviously inspired by it. So on one hand, I'm just looking forward to evolution, for example, on the staking side. You know, FINMA in Switzerland already covers the topic. The EU doesn't, right? So you all of a sudden getting into crypto, but you cannot get into all of crypto, right? Let's not even talk about lending, which becomes a bit trickier. Overall, I think there's going to be, I'm looking forward to the US really, so I think it actually, I don't, maybe Robbie mentioned the opposite, but I think it started in Europe when it comes to regulation and the US followed. Now, of course, this is true also stable coins, mid-2024 in Europe, but I'm looking forward to the competitive pressure of the American institutions putting on the European ones, because the European market, despite having standardized regulation, has still created plenty of regulatory arbitrage. And if you want to get a license in Malta, it's going to be different than getting a license with Germany under BaFin. If you want to go to Hungary, good luck actually offering crypto despite it being part of the European Union, right? So I'm looking forward to more harmonization as a consequence of additional competitive pressure, and I think that's going to be overall helpful because it's going to allow all of the market to get better access to products, have more products, and then depending on whether you're a natural person, you're obviously an institution or a high net worth individual, you're going to be able to push towards that 5% benchmark exactly the way you want.
All right, lovely. We're out of time. Thanks very much to the panelists, and thank you to the audience for your attention.